our goal here is to go a little bit deeper. What are some ideas and strategies and techniques that we find people can utilize during this time of the year, um, to impact the tax return? Really, I would say defend the tax return against what we think happens only most often after the year is over, meaning folks are in front of their tax professional during the presentation of their tax return and they realize outcomes only after the fact. Our approach is to try to discuss these strategies before the end of the year as tools to help people take control.
Welcome, everyone. Thank you for joining us today as we continue our series on Master the Secrets of Your Tax Return. We are now in session number 2. Today's topic, we will be identifying a few ideas we find useful for strategies to start the fourth quarter of tax season. Before we get started, let me introduce you to your 2 presenters today. I will start with myself. My name is Missy Klug. I have been a financial advisor for the past 23 years, specializing in the area of tax planning. And I will now introduce you to our other speaker, Henry Guzzo.
Thanks, Missy. Welcome, everybody. Yes, as Missy said, my name is Henry Guzzo. Much like Missy, been an advisor for about 25 years. Both her and I have specialization in tax planning, estate planning, and really surrounding the topics we're talking about today, ideas, strategies, to help our clients view their current year tax return and then deploy strategies that really help people expedite the pace at which they achieve their financial goals. For many, it's getting ready for retirement or approaching retirement or how to save for retirement. For others, it could be education for kids or any other financial goals.
Thanks, Henry. So in our previous session, we covered the topics that you see here. Our first episode was designed to help folks understand how a tax return works and how our progressive tax brackets operate. Try to say that 10 times. So if you missed our first session, you don't have to miss it anymore. You can scan the QR code that you see here on the page. That'll take you to the link to see our very first session as we cover the different topics that you see here. Now we're going to move into time to huddle up. So year-end strategies. Henry, take it over.
Yeah, so again, as Missy said, our goal here is to go a little bit deeper. What are some ideas and strategies and techniques that we find people can utilize during this time of the year, to impact the tax return? Really, I would say defend the tax return against what we think happens only most often after the year is over, meaning folks are in front of their tax professional during the presentation of their tax return and they realize outcomes only after the fact. Our approach is to try to discuss these strategies before the end of the year as tools to help people take control. So, pun intended, it's fourth quarter, it's football season, time to huddle up. What can we do, again, to utilize these things as tools, to help people look at the tax return this year. So the topics you see on the screen are going to be some things we talk about, as impacts. So again, in the last episode, we covered progressive tax brackets. We're not really going to go deep into that today, other than to acknowledge them here. You can see the different tax brackets we have. Again, if you'd like a little bit more information on that, please find that QR code that Missy had on the screen there. I do want to point out, as an example, if your taxable income is $250,000, you're in the 24% tax bracket. I think most people understand that. Today, we want to go deeper and in that dialogue and talking about, you know, really some techniques to both control the tax, but also should it be a scenario that you maximize that tax bracket to pay as much tax at 24%, as you can.
I think, Henry, you bring up a valid point there. I think between all the different clients that we see, we hear so many people talking about, reducing their tax bill, which makes sense. I mean, people don't want to pay more of their share of taxes than they really need to. But I think people, what they're not thinking about is, truly understanding where tax rates are headed.
Yeah.
And so we're gonna go into an example of a specific client and talk through, what we're describing here and, you know, different strategies in things that they may not be thinking about.
Well, and
Um,
and Missy, I mean, because it's historical, right? Because they're
yeah,
going and they don't know their tax bill until their tax return is done. And at that point, what can I do to drive it down? Versus when you take a proactive approach, you might look at that different and say, oh, maybe I should be doing something uh, a little different than what I've done to pay more tax.
yeah, yeah, I agree. So, all right, we're gonna look at a client here today. So Henry, let's have some fun. Let's give, instead of it just being a client, let's give our client a name. What do you want to call our clients today, Henry?
That's a lot of pressure. How about Mr. and Mrs. tired of writing checks to the IRS?
Oh, I like that. I think most people sitting on the webinar today would feel the same way. Uh, all right. So as I stated before, many of the clients that we encounter have their primary focus on reducing taxes. So let's just take a little bit more in-depth look at Mr. and Mrs. tired of writing checks to the IRS. If we look at the bottom line, because again, most clients focus on the bottom line, right? We see that this client on all of their income has a total tax liability of $45,000. I think most people would prefer to see that number much lower. Would you agree with that, Henry?
Yeah, I would agree. I believe that's an outcome. That's the most common question we get. And again, I would, lean on what we've said so far is that it's because it's a surprise to folks. It's
Yeah,
historical. It's already over.
right, exactly. They're like, well, how do we even get to this number? So let's talk about how we got to that number. So in this case, clients have wages of 100,000. Um, the numbers that I'm going to talk about now are driven off an investment portfolio. And client here has a very good investment portfolio. We're seeing $50,000 of taxable interest, $72,000 of total dividends, $100,000 of capital gains. Um, Henry, what's your observation when you're looking, in that income section? What stands out for you?
Yeah, I think you've done a good job of setting that up, Missy. Again, a working client, with a good investment portfolio. First observation I would see here would be interest income in 2024. At 50,000, my anticipation would be we're going to have a lot of folks surprised at tax time with the amount of interest on their tax return for those folks that have, a substantial cash position in checking, savings, money markets, CDs as examples. Interest rates higher for longer. Even though the Fed has recently started reducing rates, we're still going to see a higher amount of interest this year than last year. We do have concerns. People really aren't prepared for that. Again, especially those folks that carry substantial amounts. And then, as you said, clearly somebody who has done a good job saving dividends and capital gains being produced on the tax return. There are many situations where those capital gains are passive, meaning the client didn't do anything to push those capital gains on the portfolio. They're produced by mutual funds. We call those passive. But there's also situations where life is life, and you had to make sales to um, live your life, whether that be a down payment on a retirement home or expedite the pace at which you achieve a different financial goal. Maybe it was a home repair or education for kids, whatever the event might be. this situation has $100,000, of capital gains. So, those produce the income that we see here.
Yeah, I agree with you. We think about investing, investing is in a one-way street. You're traveling down the street and all of a sudden it's a three-prong. And to your point, yeah, like I got to sell an investment to go pay for my kids' education, or we had a big storm go through and, took the roof off my house and I got, there's multiple Murphy's Law, call it
Yeah.
whatever it is, things like that happen. I think what I like most about what we do is, we have the ability to, help impact clients during the tax season. Again, right? They're not coming to us and say, hey, this ended up happening. We can help guide them and prepare them throughout the year and create different tax strategies to, either maximize the tax bracket, pay a little bit more this year in taxes, or, looking towards the future. Before I do move on, let me just be very clear for everybody on today's presentation is the numbers that you're seeing are for illustrative purposes. When we actually do a forecast or do a person's tax return, we're using their real numbers, but we wanted to make it simple and clear for our presentation today. So hopefully, people aren't looking at that and like, well, where are these numbers coming from?
Right.
All right. So, Henry, as we can see here, like I had said, the ability to review a client's tax situation throughout the year while we're still in that tax year, we can help make a pretty dramatic impact for the client. And again, if we look to the bottom line, we look at their total tax, they were at 45,000. Through different recommendations, investment strategies, we were able to reduce their total tax in this scenario from 45,000 down to 29,000. That's a $16,000 tax savings. Spend some time sharing with the group how we got Mr. and Mrs. I don't want to write another check to the IRS to this point.
Yeah. So again, as we discussed so far, being able to look at the tax return during the year, has the ability to really impact that bottom line. And clearly, the situation is one where the client wanted to pay less. So, first thing we can observe here is taxable interest. Through good conversation and guidance, able to help the clients see and understand that, hey, if these are excess reserves that are just producing taxable income, can we redeploy those assets somewhere else? In this case, a municipal bond portfolio that still produces interest, but now it's non-taxable. The removal of those dollars from the tax return is substantial, to impact that bottom line. Again, only being done because we can view the tax return during the year. The next thing I see here is reduction of capital gains. Again, so as Missy said, life is life. You get to a fork in the road, you have to make a decision. In this case, capital gains were produced, but once we were able to sit down with the client and view the entirety of the portfolio, what we found is there's another position that we could sell to offset some of the capital gains already produced. What does that mean? Well, as you can see here, this PQR investment has a capital loss. By selling that fund and reinvesting in a different mutual fund, now there's $30,000 of capital loss to offset the already produced capital gains. This, I think, is one of the most often overlooked areas, not only by clients because they don't really know how to go through and harvest those losses, but really by other advisory teams that don't have an eye towards income tax. It's not something that's a typical behavior. So our ability to do that, I think, is impactful. But I think probably the most telling maneuver on this, alternate strategy folks are looking at here. And again, everybody's eyes are drawn to the bottom line of tax reduction. But how do we get there? Well, you can see the Roth conversion strategy of adding an additional 100,000 of income, but then you also see the charity line increasing by 100,000. So the Roth conversion is a not something we're going to go very deep into today. Again, covered in our previous session. I would encourage folks that want some more information, to look at that session. But it's moving money from an IRA, which is a pre-tax vehicle. Money goes into those accounts prior to you paying tax. And then when it's converted to a Roth, that's taxable in the year in which the conversion is done, which is why it's showing up here. But then when you access dollars from a Roth IRA, different than an IRA, it's 100% income tax free in retirement. Okay. So that's what the Roth conversion is. But then we offset that income in this scenario by utilizing what's called a donor advised fund. So, again, another often overlooked tool to help clients impact the current year tax return. You could see in the previous scenario, they had charity of $1,100, but they're taking the standard deduction, meaning the benefit to them from a tax perspective of their charitable donations is not being realized. What we were able to do through conversation with the client is utilize this donor advised fund. A donor advised fund is an investment where, in this case, we moved a highly appreciated asset into a donor advised fund, no tax for moving that in, and then get $100,000 tax deduction on the current year's tax return. That example of utilizing that strategy gives the client the ability to now, instead of having to write checks to the charity from their personal checking and savings account, they go to the investment and make the donation directly from the investment. Couple things to note. It's an irrevocable donation. You can't claw that back for use personally, but there's no requirement in any given year to allocate those funds to a charity. You have the rest of your life to do it. So this client is clearly charitably inclined to some degree every year, but we're able to move a substantial amount of money to a Roth IRA, avoid the tax, and give them the ability to make charitable contributions in the future and get a deduction in a year where they normally wouldn't. It's a really useful strategy for folks that truly desire, to pay less tax, but also, get some assets into a Roth.
Yeah, I think Henry, what you described is it's just so impactful. And I don't think that these types of strategies, I don't think people are getting these types of strategies on a day-to-day basis. I mean, to be able to take $100,000 in pre-tax money and convert it, and now it's all growing tax deferred and 100% tax free in the future, and knowing that by this donor advised fund you just described offset 100% of that tax liability, that's impressive and very, great tax planning. And again, I would even say, you know, again, we're using these dollar amounts for illustrative purposes as it aligned to this particular client, but, think about your own situation and, even if the dollar amounts aren't exact, think about the impactfulness that you can create on your own tax return.
Yeah, and Missy, to your point, these are hypothetical, but as in most cases, we base these hypotheticals off of our actual client experiences. So this is a real life example of something we're able to help clients with,
Yep.
um, because of those conversations being done proactively.
Right. All right, so let's spend a little bit of time around where we're currently at today. So when we just described our current client, Mr. and Mrs. Again, I don't want to write another check to the IRS. They had $292,000 of taxable income. Well, under today's current tax rates, that puts them in the heart of the 24% tax bracket. Now, if we look over to the far left corner, that that 292,000 under prior tax law, so again, pre, 2018, that client would end up falling in the 33% tax bracket. So a lot of our clients that we deal with today fall into that 24 to 32% tax bracket. And I think, we believe more and more today with our low tax rates and the fact that, our tax rates are going to move and get, they're going to get bigger, right? There's a good chance that we're going to go back to the 2017 tax rates. We believe it's important, for clients to push the thresholds within their own tax bracket. And should they be paying more in taxes today to maximize a lower tax bracket compared to directionally, I think, where we're going in the future? Henry, what are your thoughts on that?
Yeah, I agree completely. As Missy said, the Tax Cuts and Jobs Act is expiring at the end of 2025. Even the example we gave, because it was client led to pay less tax, is based on that. Hey, let's write less checks to the IRS. But the reality of the situation is the headwinds we are facing with income tax tell us that the tax rates we're in are going back to what they were. And I agree completely with Missy. The vast majority of folks we are in front of are in this 24 to 32% income tax range. Look at where those income numbers land in in future tax rate um, amounts. So maybe the question we should be asking, is not are they Mr. and Mrs. tired of writing checks to the IRS today? But what are those checks going to look like when they hit retirement? And I believe there's a very narrow time horizon of 2024 and 2025 to push these thresholds. And I think it's a great use of words, Missy. Push that threshold. If you're in the 22% tax bracket and you have room, should you push that threshold? Because in retirement, you're not going to be there. And I think one of the great fallacies we have in this industry is you're going to be in a lower tax bracket in retirement. I don't see it.
Yeah.
People's ability to save and their portfolio and Social Security income is produced at such a rate that tax brackets don't move. They only go up. Now, I believe people have less income. That's factual
Mhm.
in terms of earned income, but the portfolio production is not there. So, yeah, I think you're hitting it on the head. Maximizing the bracket you're in is probably a more valuable conversation as it relates to future rates, than just driving that tax bill down.
Yeah, I agree with what you're saying. And, again, that the impactfulness of being able to help a client throughout the year versus, hey, it's done, we can't reverse anything, let's try to do better in the next year. Um, it's clients really see the value in what we do, especially from the lens of a tax perspective.
Yeah, and we'd be remiss if we were talking about pushing the limits of those tax brackets to then neglect to cover um, your modified adjusted gross income, often referred to as IRMA, your Medicare premium income. So just keep in mind for those people, those folks approaching age 65 or at 65, income produced in 2024 affects your 2026 modified adjusted gross income and thusly your Medicare premium. Not a reason to fail to deploy a strategy to increase taxable income, because I believe the impact in this example we used, $100,000 Roth conversion is far more impactful over time than an increase of Medicare premium will be. Often we give the example of you don't walk past $100,000 bill on the sidewalk to pick up a nickel or dime. That being said, it is something we want to make sure people are aware of, so that um, they see and we communicate. These decisions need to be made in thorough review.
Yeah, and I think Henry, I'll also add to that, this isn't a surprise to clients when we're running these type scenarios with and aligning what we're doing to the client's goals and objectives. We can show them with the software that we use where they would fall based on the recommendations that we're suggesting and they're implementing. They'll know right away. It isn't going to be a surprise that they get a letter, from Social Security saying, hey, your Medicare premiums have now increased by 70. They're going to know before they even go forward with the recommendation.
Yeah. Yeah. So in conclusion today, again, I believe most people come into their, tax preparation meeting with their professional, and it's transactional. They're showing up with their list of documents. They've uploaded them. The tax bill is a surprise. It's not known, and thusly the reaction. The goal of people is to drive that number down. So that's tantamount to being in a car and looking in the rearview mirror. Where was I? Where did I travel from? And now I'm at where I'm at. What can I do to change that? What we've talked about today again is um, being in the same vehicle at the same place, having completed the same transaction, but looking ahead. You're now looking through the windshield to see where are we going? What are the tax rates going to be so that I change the decisions I make today to affect that path. And I think it produces significantly different outcomes and results because you're looking at the future to say, all right, how can I have a better outcome for retirement because I made decisions today based on where things are going. There's a pothole in the road. I need to avoid that.
I agree. Can't drive a car just looking out the rearview mirror.
Not well, at least.
No, absolutely not. All right, well, we are at the end of our second session in our series of events. And again, we are doing a series of events. So be looking forward to future emails on series number 3 of our event. And we hope and look forward to seeing you all next session. In the meantime, please scan our QR code at the very bottom of the page. This will take you to our website, blumarktax.com. In our website, you're going to find valuable information, a tremendous amount of resources. There's also a part of our website that if you have questions around your own situation, want to meet with Henry or I or any of our teammates, you can send that information in. We'll get you scheduled with an advisor to talk about your specific situation and what we can do to help impact your tax situation as well as your financial situation. But in the meantime, on behalf of Henry, myself, and the entire Blumark tax team, we want to thank you for joining us today. We hope you have a wonderful rest of your day, and we look forward to seeing you in the next session.
Thank you.